Welcome to today's class. Today, this is the second class on the topic capital budgeting techniques. Today, we will learn about accounting rate of return or average rate of return, which is one of the most prominent non-discounted cash flow technique of capital budgeting. Now, what is ARR? Accounting rate of return or average rate of return or ARR as it is known, it is the average rate of return found out by dividing the average profit, that is EBIT, multiplied by 1 minus T, where T is the tax rate, by average investment. So ARR equals to average profit divided by average investment. What is the acceptance criteria? We accept if ARR is greater than the minimum rate. We reject if ARR is less than the minimum rate. What are the advantages? It uses accounting data. It is easy to understand and calculate. It gives more weightage to future receipts. What are the disadvantages? It ignores time value of money. It does not use cash flow. It is not an objective way to determine the minimum acceptable rate of return. There is no objective way to determine the minimum acceptable rate of return. So, let's get on with an example. First example, a project will cost rupees 4 lakh. Its EBITDA, that is earning before depreciation, interest and tax, during 5 years life is expected to be 1 lakh, 1 lakh 20,000, 1 lakh 40,000, 1 lakh 60,000 and 2 lakh. If we assume a 40% tax rate and depreciation on straight line basis, then how the ARR will be calculated? In this way. First column is the year, then earnings before depreciation, interest and taxes, the amounts are given. As the cost of the machine is 4 lakh and the life is 5 years, straight line depreciation per year is 80,000. Now, after deducting the depreciation, we get the earnings before interest and tax. 1 lakh minus 80,000 equals to 20,000. If tax is calculated at 40%, then 8,000 is the tax. So earnings before interest and taxes multiplied by 1 minus T, that is after tax, EBIT is 20,000 minus 8,000 equals to 12,000. Similarly, for the next year it is 24,000, for the next year 36,000, for the next year 48,000 and for the fifth year it is 72,000. Total is 1,92,000. If we divide it by 5, we get 38,400. That is the average profit. Now let us find out the average investment. What is the book value of investment? Beginning it is 4 lakh, at the end it is 3,20,000 because 80,000 depreciation has been deducted. So 4 lakh minus 3,20,000 equals to 3 lakh minus 80,000 equals to 3,20,000. Again in the next year 3,20,000 minus 80,000 equals to 2,40,000. In this way we get the average. We add these two and divide it by 2. We get 3,60,000, 2,80,000 and these figures. The total is 10 lakh. If we divide it by 5, we get 2 lakh. On the other hand, we can also find out the average by just dividing the cost of the project by 2. 4 lakh divided by 2 equals to 2 lakh. Again, here this 10 lakh divided by 5 equals to 2 lakh. So what is the ARR? ARR equals to 38,400 divided by 2 lakh equals into 100, that is 19.2%. So accounting rate of return or average rate of return in this case is 19.2%. Let's come to the second example. Determine the ARR from the following data of two machines A and B. There are two machines, machine A and machine B. The cost is 50,000 and 60,000. Annual estimated income after depreciation and tax In year 1 it is 4,000, 5,000, 7,500, 9,500, 11,500, 37,500. 37,500 is the total. For machine B, 12,000, 10,000, 8,000, 9,000 and again 8,000. Total is 47,000. Now estimated life in years is 5 years. This is also 5 years. The salvage value is 5,000 and 6,000. So we will find out the average income from machine A. That is 37,500 divided by 5 equals to 7,500. Average income of machine B, 47,000 divided by 5 equals to 9,400. Average investment of machine A equals to cost minus salvage value. What is the cost? Cost is 50,000 minus salvage value 5,000, that is 45,000 divided by 2. It is 22,500. For machine B, cost is 60,000, salvage value is 6,000. 60,000 minus 6,000, that is 54,000 divided by 2 equals to 27,000. So this is the average investment. So ARR equals to average income divided by average investment into 100. For machine A, ARR equals to 33.33%. For machine B, ARR equals to 34.81%. So here we see that the ARR of machine B is greater. So according to ARR principle, investment in machine B is advisable if these two are mutually exclusive investments. So with this, we have come to the end of today's class. If you have any doubts or any questions, feel free to comment. I will be happy to answer. Thank you for watching this video.